Hello, I'm Katie St. Ors, certified financial planner, tax strategist, and producer of The Deep Dive. Welcome to Season 3, Episode 44, and today we will do a deep dive into the Treasury market and bond vigilantes. Okay, it looks like Elizabeth and Michael are settled behind the microphones, so let's get going.
Welcome to The Deep Dive. We're kicking things off today by looking at something that definitely caused some ripples, some real movement in the financial markets recently.
Yeah, you're talking about the U.S. Treasury market, right?
Mm-hmm.
Early to mid-April 2025.
Exactly. We saw some, pronounced tension, I think is a fair way to put it, sharp movements in government bond yields.
Especially that spike around April 9th. That got a lot of attention.
It certainly did. And, that volatility brought back a term that many listeners will probably remember, a phrase that's been around but suddenly felt very relevant again: bond vigilante.
Ah, yes. Edward Denny's term from, the early 80s?
That's the one, coined way back then. It basically describes bond investors who, they kind of act collectively.
Not formally, of course.
No, not like a club. But they sell off government debt, sometimes en masse, when they think policies are getting inflationary or, fiscally irresponsible.
Right. They become this sort of informal market check on how governments are managing their finances.
So the big question we're trying to tackle in this deep dive is what we saw in April 2025 a real return of those bond vigilantes, like the ones from the 80s and 90s?
Or is it maybe something different, shaped by, all the pressures we have today?
Exactly. We're dealing with unprecedented levels of government debt now, ongoing worries about inflation, even if it's moderated a bit.
Central bank policies are always shifting, and then there's big policy uncertainty, like those trade tariffs you mentioned.
Right, and interestingly, the conversation now, it seems less just about inflation compared to maybe what drove the original vigilantes. It feels broader.
I think that's right. The concerns seem to cover a wider range of risks now.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
It's not only rising prices, but also just the sheer amount the government needs to borrow.
And maybe the credibility of economic policies overall, especially in, this globally connected world.
Precisely. It's a complex picture.
Okay, so let's try to unpack it. Over the next little while, we're going to dig into the specifics of what was driving the Treasury market back in April 2025.
We should probably look at the history too, right? The whole concept of bond vigilantes.
Definitely. Explore the history, the idea itself, and then figure out how relevant it is today in, the spring of 2025 context.
And maybe touch on the potential consequences if these kinds of market pressures ramp up.
Yes. Our mission, really, is to understand if this was a genuine comeback of the vigilantes, or maybe just a unique reaction to our current economic climate.
A familiar pattern or a new response to different pressures.
Got it. So let's set the stage. What exactly was happening in the bond market during April 2025? Can you walk us through the timeline a bit?
Sure. So that period, let's say roughly April 5th to April 26th, it was definitely active for U.S. Treasury yields.
Okay.
What's kind of interesting is right after that tariff announcement on April 2nd, yields actually dipped initially.
Oh, okay. Why would that be?
Well, often when there's new uncertainty, investors tend to flock to perceived safe assets, right? Like government bonds. So buying pushes prices up, yields down.
Makes sense. Safety play.
Exactly. The 10-year Treasury yield, for instance, it fell to around 3.90% by April 4th.
So an initial move into bonds, but I take it that didn't last.
No, not at all. That trend reversed, and pretty sharply. Between Monday, April 7th, and Wednesday, April 9th, we saw a really significant surge in yields.
How high are we talking?
The 10-year yield actually hit 4.50% intraday at one point.
Yeah.
That's a fast climb, signaling quite a bit of selling pressure on bonds.
Wow, okay. And then things cooled off a bit.
Yeah, there was a partial retreat. It came after a modification, sort of a walk back on the tariff policy was announced.
Ah, okay. Policy change, market reaction.
Seems like it. So by around April 11th, the 10-year yield had settled back a little, maybe around 4.42%. The 2-year yield, which is usually more sensitive to Fed policy expectations.
Right, near-term stuff.
That was around 3.94% then.
And what about the overall shape of yields? The yield curve, was anything interesting happening there?
Well, the curve was still showing some inversion in parts. Shorter-term yields were higher than some longer-term ones. That's often seen as a possible signal of an economic slowdown ahead.
People watch that closely.
They do. But there was also this growing expectation that the curve would steepen looking forward. meaning longer-term yields would rise relative to shorter ones.
And why was that?
Partly driven by worries about the government deficit, the sheer amount of borrowing needed down the road. That tends to put upward pressure on longer-term rates.
We actually have a table in our notes showing these yield movements across all different maturities, 4-week, 3-month, 10-year, 30-year. You can really see the volatility.
Yeah, even the 20-year bond, it saw some big moves and hit recent highs during an auction around that time.
Yeah.
It definitely paints a picture of a market feeling the strain.
So what was causing all this nervousness? What were the main drivers?
Well, there are several things feeding into it, all kind of interconnected. First off, you always have to look at the Federal Reserve.
The Fed, right. Always central. What was their role here?
Well, Fed Chair Powell had acknowledged that inflation was proving stickier than they might have hoped. Near-term inflation expectations were ticking up, too.
But the market reaction.
Despite that, the markets were, interestingly, still pricing in multiple interest rate cuts for 2025.
Cuts. Even with sticky inflation, why?
Part of it seemed to be fear that those new tariffs could actually slow down the economy significantly. So the market was maybe anticipating the Fed would cut rates to counteract that slowdown.
So the tariffs created this weird cross-current for the Fed?
Exactly. It put them in a real bind. On one hand, tariffs could boost inflation if import prices rise, which argues for keeping rates higher, right?
Right, fight inflation.
But on the other hand, if tariffs slam the brakes on economic growth, that might argue for lower rates to support the economy.
A real dilemma.
Definitely. And that uncertainty, you could see it reflected in the 2-year Treasury yield. It swung around quite a bit from maybe 3.50%, suggesting the market expected a looser Fed.
Lower rates coming.
All the way up near 4.0%, indicating maybe a more neutral Fed stance was expected. Big swings based on trying to guess the Fed's reaction.
Okay, that makes sense. The market trying to read the tea leaves on the Fed's response to tariffs. But what about inflation itself? Was that still a core worry?
Oh, absolutely. You can't ignore that. Even though inflation had come down from the peaks we saw back in mid-2022, the underlying trend was still a concern. It was persistent.
Recent data showing that.
Yeah, indicators like the core PCE index, which the Fed watches closely, and surveys of what consumers expect for inflation down the road, they were still showing elevated levels. Some were even ticking up slightly.
And sustained inflation is bad news for bondholders.
Exactly.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
Because it eats away at the real value of the fixed payments they receive. So investors naturally demand higher yields on longer-term bonds as compensation for that inflation risk.
And the tariffs just poured fuel on that fire.
It certainly seemed to amplify those fears, yeah. The possibility of higher import prices just added another layer to the existing inflation concerns.
Okay, so underlying inflation worries plus tariff fears. Now let's talk about the elephant in the room. Government debt and deficits. How big a factor was that?
Huge. You have to consider the backdrop. U.S. government debt is over $36 trillion now. And the projections, well, they show deficits averaging around 6% of GDP for the next decade.
That's a lot of borrowing.
It is. And financing all that requires issuing a massive amount of new Treasury bonds. We saw an example mid-April, that $13 billion auction of 20-year bonds on the 16th.
How did that go?
Well, it cleared, but the demand wasn't as strong as the previous month. The bid-to-cover ratio dipped. And importantly, the yield needed to sell all those bonds was higher, 4.810%.
So the market needed a bit more enticement to absorb that debt.
That's one way to put it. This constant large supply of new government debt puts this sort of structural upward pressure on yields. The market has to digest it all.
More supply usually means lower prices, higher yields, basic economics. Okay, let's zero back in on the tariffs themselves. You said they were a major catalyst. How exactly did they mess with the bond market?
That April 2nd announcement was definitely pivotal. The initial plan, the one involving reciprocal tariffs on goods from many countries, it immediately sparked worries on two main fronts.
Okay, what were they?
First, like we said, higher import costs fueling inflation fears. Second, anxiety that these new trade barriers would choke off economic growth. Trade friction, maybe lower consumer and business spending.
So the dreaded combination, potential for higher inflation and slower growth, sort of stagflationary concerns.
Exactly. And it really seemed like that policy uncertainty, maybe even more than the latest economic data point, was what really drove that sharp Treasury sell-off between April 7th and 9th.
The market just didn't like the unpredictability.
It seems that way. It felt like the market was demanding a higher risk premium just to hold Treasuries. because of the uncertainty and the potential negative economic fallout from these tariffs.
And the proof is in the pudding, so to speak, with the policy change.
I think that's the most telling part. The subsequent announcement on April 9th, the 90-day pause on those reciprocal tariffs, though notably not for China.
Right. And President Trump explicitly linking that pause to watching the tricky bond market. That connection is pretty direct.
Wow.
And what happened? Bond prices partially recovered, yields retreated somewhat. That sequence policy proposal, sharp negative market reaction, policy adjustment linked to market reaction, strongly suggests the market influenced the policy shift.
So a key takeaway here seems to be that policy uncertainty, especially around things like fiscal policy or trade, can really quickly translate into higher borrowing costs because the bond market demands compensation for that extra risk.
Absolutely. That seems to be a clear lesson from April.
Okay, so we've looked at what happened in April 2025. Now let's zoom out a bit and dig into this whole idea of bond vigilantes. Theoretically, who are these guys?
Well, going back to Ed Yardeni's definition from the early 80s, they're essentially bond market investors. And they act, collectively, though, informally, to discipline governments.
Discipline them how? By selling bonds when they see policies they think are inflationary or fiscally irresponsible. As we said, it's not a formal group, no membership cards or anything. It's more about a market dynamic.
So it describes a behavior more than a specific cabal of investors.
Exactly. And what motivates them? Primarily, it's self-interest. They need to protect the real value of their investments.
Makes sense. Bonds pay fixed amounts over time.
Right. And inflation chews away at the purchasing power of those future payments. High government debt also raises red flags, worries about repayment, or maybe the government trying to inflate away the debt.
So when policies seem to increase those risks,
Investors react. They demand higher yields to compensate for taking on that perceived extra risk.
and how do they actually make the government feel the pain? It's
Okay.
about prices and yield, right?
Precisely. That fundamental inverse relationship. When a lot of investors start selling government bonds, whether you call them vigilantes or just concerned market participants, that increased supply pushes bond prices down. Now, the interest payments, the coupons on existing bonds, they're fixed. So if you buy that bond at a lower price, your effective rate of return, the yield, is higher.
Got it. Lower price, higher yield.
And that higher yield on existing bonds makes it more expensive for the government to borrow new money. They have to offer similar or maybe even higher interest rates on new bonds to attract buyers.
So it directly increases the government's borrowing costs.
Yes. And that rising cost can pressure policymakers. It might make them rethink potentially inflationary spending plans or push them towards more conservative fiscal policies. Sometimes even just the threat of a big sell-off can influence decisions.
The fear of facing higher borrowing costs is a strong motivator. But you stress this isn't usually some coordinated plot.
That's a really important distinction. Bond vigilantism is rarely some secret conspiracy. It's usually the combined result of many individual investors all acting independently.
Just doing their own risk assessment.
Exactly. They're reacting rationally to new information. Maybe a policy announcement like the tariffs or fresh economic data. If that info signals higher inflation risk or unsustainable debt ahead.
Lots of people might decide to sell bonds or demand higher yields at the same time.
Precisely. And the aggregate effect of all those individual self-interested decisions looks like a market protest or discipline. But the driver is individual risk management, seeking profit, avoiding loss. The policy constraint is really a consequence of that widespread behavior, not necessarily the primary aim of every single seller.
Okay, that clarifies the mechanism. It's the collective outcome of individual actions. So this isn't a new phenomenon.
Yeah.
When have we seen these market forces really flex their muscles in the past?
Oh, there's some classic examples. The 1980s, obviously, that's when Yardeni coined the term. It was a high inflation decade coming off the 70s.
Right.
Investors were deeply worried about inflation destroying their returns. So they demanded really high yields on Treasury bonds. Their actions, selling bonds, pushing yields up, are often seen as working alongside the Fed under Paul Volcker.
Volcker was aggressively fighting inflation then.
He was. So the market pressure arguably reinforced the Fed's tight monetary policy. Yields back then often traded above the rate of nominal GDP growth. That shows you how skeptical investors were.
So the 80s focus was mainly inflation. What about the 90s? I feel like I've heard about the Great Bond Massacre.
Ah, yes, the 93-94 period. That's a textbook example people point to. Early in President Clinton's first term, the market got worried about potential spending increases and the budget deficit.
And the reaction was strong.
Very strong. The 10-year Treasury yield shot up. It went from around 5.2% in October 93 to over 8.0% by November 94. That's a massive jump.
Wow. And that had consequences.
It's widely credited, yeah. That surge in borrowing costs is seen as a key factor influencing the Clinton administration, advised by Treasury Secretary Robert Rubin at the time, to really prioritize deficit reduction.
And they did achieve surpluses later on.
They did, and bond yields eventually came back down. It led to that famous quote from Clinton advisor James Carville.
Oh, yeah.
He said he wanted to be reincarnated as the bond market because it could intimidate everybody. Really highlights the perceived power.
Huh. That's a great quote. But was it just the market flexing, or was the Fed involved then, too?
That's a fair point. There's some debate. The market pressure was clearly intense. But the Fed, under Alan Greenspan then, was also tightening monetary policy during that time. So it was likely a combination of market forces and Fed actions driving yields up.
Okay. What about more recently, after the 2008 crisis? Were there whispers of vigilantes then?
There were, absolutely. After the financial crisis, you had the big government stimulus packages, TARP, all that. Concerns about long-term debt sustainability definitely surfaced. People started asking if the vigilantes were back.
But did yields actually spike then?
Not really, no. That's the interesting part. Through much of that period, Treasury yields stayed surprisingly low.
Why was that, if the debt was piling up?
Well, critics like economist Paul Krugman pointed to the Fed's quantitative easing QE. The Fed was buying huge amounts of government bonds itself.
Right, pushing prices up and yields down.
Exactly. So in that case, it looked like central bank intervention was maybe overshadowing or counteracting any potential vigilante pressure. QE kept a lid on yields, despite the fiscal concerns.
So central banks can definitely muddy the waters or even neutralize the vigilante effect.
They certainly can play a huge role, yeah. Their actions can be a powerful counterforce.
Have we seen clear examples of this kind of market discipline internationally?
Oh, definitely. A really stark recent one is the UK in 2022. Remember the Liz Truss government?
Vaguely, yeah. The mini-budget fiasco.
That's the one. They proposed big, unfunded tax cuts. The market reaction was immediate and brutal. A massive sell-off in UK government bonds, they called them gilts, and the British pound plunged.
And it forced their hand.
Completely. The market turmoil was so bad they had to reverse the policies almost immediately. The chancellor of the exchequer was fired, and Truss herself had to resign not long after. A very clear, very fast demonstration of market power.
Wow. Any other?
Well, you could look at the Eurozone sovereign debt crisis, starting around 2009. The rising bond yields in countries like Greece, Portugal, Ireland. That was widely seen as market discipline, pushing for austerity measures.
Though the ECB eventually stepped in there too, right?
Yes, absolutely. The European Central Bank's interventions, like Mario Draghi's whatever it takes commitment, were crucial in calming those markets eventually. But the initial yield spikes were certainly interpreted as market pressure.
Okay, so looking at these historical and international examples, it seems like this market pressure really bites hardest when policies kind of stray pretty far from the perceived norms of fiscal or monetary stability.
That seems right. And maybe also when central banks are either constrained in their response or perhaps choose not to fully counteract the market's reaction.
So you need a clear policy trigger, something the market really dislikes, and maybe a market that's already a bit skeptical or nervous.
That combination seems potent. A concerning policy move hitting a skeptical market seems to be the recipe for a strong vigilante-type reaction.
And as you pointed out, the events back in April 2025 here in the U.S., the tariff plan, the yield spike, the policy pause explicitly linked to the market, it does seem to fit that pattern somewhat, doesn't it?
It certainly has echoes of those past episodes, yeah.
Which brings us right back to our main question. Given everything, the huge debt, the sticky inflation, the government's borrowing needs, that tariff uncertainty in April 2025, were the bond vigilantes really back?
It's such a tricky question. It's really nuanced. I mean, you can definitely make the case for their return.
What's the core argument?
Well, you have the confluence of factors, massive government debt, plus policies like the tariffs that could be seen as potentially inflationary or destabilizing. That creates the kind of environment where you'd expect vigilantes to stir.
And the market reaction itself.
That rapid yield spike after the tariff news? Yes. And maybe the strongest piece of evidence. The administration explicitly saying they paused the policy, partly because they were watching the tricky bond market. That's pretty direct market influence. Some commentators definitely declared they're back.
Okay, so that's the yes case, but you said it's nuanced. What are the reasons to be skeptical? Why might it not be a full return?
Well, first, the sheer size and depth of the U.S. Treasury market. It's just enormous, incredibly liquid. It's much harder for any group of investors, no matter how influential, to truly dictate terms compared to maybe smaller markets or past eras.
Too big to bully, maybe.
Sort of. And then you absolutely cannot discount the power of the Federal Reserve. The Fed has so many tools to influence interest rates.
Like QE, which we talked about earlier.
Exactly. The Fed has shown it can push down yields if it wants to, even if there are underlying fiscal worries. That power wasn't necessarily as explicit or as utilized in past vigilante episodes.
Any other factors?
Yeah, also the global role of U.S. Treasuries. They're still seen as one of the safest assets in the world. So there's often this persistent demand from international investors, central banks, that helps absorb selling pressure. The safe haven bid.
So putting that together, maybe the April yield spike wasn't quite a full-blown vigilante uprising. Maybe it was something else.
It could be interpreted differently, yes. Perhaps it was more about a rational repricing of risk. Investors looking at the new tariff policy, the uncertainty it created, the ongoing need to finance large deficits.
And just deciding they needed a higher return to compensate for those specific risks, rather than making a broad statement about fiscal irresponsibility in general.
Exactly. It might have been less of an ideological protest against inflation or debt per se, and more of a logical market adjustment to new, specific information and uncertainty, a recalculation of the required risk premium.
That actually leads to a really interesting thought. Maybe the focus of the market's pressure, or what we call vigilantism, has shifted over time.
I think that's a crucial insight. The vigilantes of the 1980s, their main target seemed to be high inflation. That was the big enemy.
Right.
But today, maybe the market's reaction is less about trying to force the Fed's hand on inflation. I mean, the Fed is managing inflation, even if cautiously, and more about demanding a higher risk premium or term premium for holding long-term debt.
A premium for what, exactly?
Well, not just for future inflation risk, but also for the increased uncertainty around policy like those tariffs, for the sheer volume of bonds the market has to absorb now, and for worries about the long-term fiscal health of the government.
So it's a broader basket of risks today.
It seems that way. The focus appears to have shifted, as Yardeni himself and others have noted, from mostly inflation in the 80s to maybe the sustainability of government debt issuance being a primary concern now. The whole macroeconomic landscape has changed.
So the 2025 market reaction might be driven more by, let's say, pragmatic risk calculators dealing with huge debt and policy surprises, rather than purely ideological anti-inflation crusaders.
That feels like a plausible modern interpretation.
Yes.
The label vigilante might still fit in the sense of market discipline, but the specific drivers and focus might have evolved.
Okay, that's a really useful distinction. So whether we call them traditional vigilantes or something else, if this kind of bond market pressure does gain more strength, what are the potential consequences we should be thinking about?
Well, the most direct and obvious one is higher borrowing costs for the government itself.
Right. Higher yields mean higher interest payments on the national debt.
Exactly. And with debt levels already so high, even small increases in interest rates can add up to really substantial amounts in annual debt servicing costs.
Yeah.
We're talking hundreds of billions, potentially.
And the CBO projections already show those costs rising sharply anyway.
They do. So increased market pressure would just make that worse. It could potentially crowd out spending on other government priorities, defense, infrastructure, social programs, or force difficult choices about raising taxes or cutting spending elsewhere.
And those higher government borrowing costs would likely spill over into the rest of the economy.
Almost certainly. U.S. Treasury yields are the benchmark, the foundation for so many other interest rates.
Like mortgages.
Absolutely. When Treasury yields rise, you typically see 30-year fixed mortgage rates go up too. That makes buying a home less affordable.
What about businesses?
Businesses also face higher costs when they issue corporate bonds or take out loans for investment. That can put a damper on business expansion, hiring, innovation.
And consumers.
Same story. Rates on things like car loans, credit cards, personal loans often track Treasury yields to some extent. Higher rates mean less disposable income for households, squeezing budgets.
So, putting it all together, it sounds like this could act as a real brake on the economy.
Precisely. The combined impact, higher borrowing costs for the government, for businesses, for consumers, it can significantly slow down overall economic activity. It could lead to weaker GDP growth or even increase the risk of a recession.
And thinking back to the core idea of market discipline, it could also limit the government's options, right, in terms of future policy.
Yeah, exactly. That's the heart of it. If the bond market reacts very negatively, demanding much higher yields in response to, say, a proposed big spending program or large tax cuts.
The resulting surge in borrowing costs might make that policy just too expensive, politically or economically.
Right. It forces policymakers to think about the market's potential reaction before they act. It imposes this kind of external constraint on their fiscal choices.
And lastly, these periods of bond market stress, they don't usually happen quietly, do they? Does it affect other markets?
No, they often come with increased volatility across the board. Stock markets can get choppy, currency markets too. Uncertainty about interest rates, about fiscal stability, it tends to make investors more risk-averse, generally, leading to wider market turbulence.
Okay, so potential consequences are pretty significant. Higher government borrowing costs, a drag on the economy, limits on policy, and more market volatility overall.
Yeah, that sums up the main risks if that market pressure really intensifies.
So let's try to bring this all together. We definitely saw some significant turbulence, maybe even drama in the U.S. Treasury market back in April 2025.
No doubt about it. That yield spike and the whole episode around the tariff policy adjustments were notable.
And it certainly thrust that old term, bond vigilantes, back into the conversation.
Yes, and the way the market reacted to those tariff proposals, and then the administration explicitly linking the policy change to that reaction, it does fit the historical pattern of market pressure influencing policy. There's a clear parallel there.
But as we've spent a lot of time discussing, today's world is different. The sheer scale of government debt, the huge role of central banks like the Fed. It makes a simple comparison to the 80s or 90s a bit, complicated.
It really does. The context is crucial. So whether you want to label the April 2025 events as a full comeback of the traditional bond vigilantes, or maybe frame it as a more modern, rational repricing of risk driven by debt levels and policy uncertainty.
The underlying point seems to be the same.
I think so.
Yeah.
The fundamental message is that the bond market, however you label its participants' motives, still holds significant power. It can materially influence the government's cost of borrowing and, by extension, policy itself. That power hasn't disappeared.
Which leaves us, and you the listener, with a final thought to chew on. Given these persistently high levels of government debt, and let's face it, the constant potential for future policy surprises or shocks, in what other ways might the bond market exert its influence in the coming years? Even if we don't see a carbon copy of the 1980s bond vigilantes riding high again, how else might this market discipline manifest itself?
It's definitely something worth keeping a very close eye on.
Indeed. Thanks for taking this deep dive with us today.
It's been a pleasure.
We'll see you next time.
See you later.
Okay, great. That's a wrap. I'm Katie St. Ors, and let me send out a huge thank you for listening. If you want more content on personal finance and small business, head over and find me on YouTube. You can also find me on Spotify, Amazon Music, TikTok, and Apple iTunes. Thanks again for tuning in, and I'll catch you on the next Deep Dive podcast.